Mr. James Lavish, how are you doing today, my friend?
Just look at all the global investment assets. $100 trillion of stocks, $110 trillion of bonds, $250 to $300 trillion of real estate. You've got $20 to $30 trillion of art and collectibles. You've got about $10 trillion of gold. And you just say that adds up to somewhere about, even if it's just $500 trillion. Look, you've got five investment firms that control $30 trillion of assets. You've got BlackRock, Vanguard, UBS, Fidelity, and State Street. That they control over $30 trillion of assets. 1% of $6 trillion is about $300,000 Bitcoin. And then 2% is 600, and 3% is just about $1 million. So when you have a market shock and somebody comes out with a huge order that has to sell and they can't get filled, and it forces that price way down and that interest rate way up, that's volatility and that's bad.
Welcome back to the Fix the Money, Fix the World podcast that is brought to you by Amber, the only place I'm using to buy my Bitcoin. And today I want to quickly introduce a podcast that I just recorded with the one and the only James Lavish. James is a prolific thinker in the Bitcoin space. He has one of the fastest growing newsletters in the entire Bitcoin and broader macroeconomic space called The Informationist. And today we're going to break down some of his best newsletters that he's written recently. We're obviously going to talk about the debt spiral that is going on around the world. If the background of my screen didn't give that one away, we're going to be breaking down the $31 trillion of debt that threatens to break the great US empire. We also obviously talk about the dollar milkshake thesis. We talk about the currency crisis we're living through. Okay, so very interesting. I really hope you enjoy this one. Before we jump into it, I want to quickly give today's show sponsors a shout out. So starting out with Amber, they are a Bitcoin only exchange who have just rolled out to 62 countries around the world, making us the fastest growing Bitcoin exchange out there. And to celebrate, they are giving all of you guys $10 of free Bitcoin if you sign up with Amber today. All you need to do is press the link in the description of today's video. It's going to take you to a landing page that looks something like this. If it asks you for a promo code is Luke, and then followed by the number 1, Luke1. Very easy to remember. Highly recommend you check out Amber. They're a great company, and of course, Bitcoin only. The Celsius debacle followed by BlockFi and the recent FTX debacle should show you guys that you should not be trusting any shitcoin casinos, but you shouldn't even be trusting a Bitcoin only exchange like Amber. You shouldn't trust any exchange. That is the beautiful thing about Bitcoin. Bitcoin is about taking self-responsibility and not trusting anyone. That is why I'm also very happy to be sponsored by another Bitcoin only company, and they produce something called a Bitbox O2 hardware wallet. This is a hardware wallet that lets you take custody of your Bitcoin in the easy and simple way. Obviously, guys, this is the cheapest hardware wallet on the market, and it is the easiest hardware wallet to use. I have used them all. I've used Ledgers, Trezors, Cold Cards. I've played around with it all, and I couldn't recommend the Bitbox O2 hardware wallet anymore. This is what they look like. They're a great little device, and they get even 5% cheaper if you use a promo code Bitcoin Made Simple. No spaces, Bitcoin Made Simple. Highly recommend you check them out. And while we're talking about sponsors, if you want some of the best Bitcoin clothing in the space, I highly recommend you guys check out a company called Hodling Apparel, okay? They make some amazing t-shirts, hoodies, sweaters, hats, you name it, they've got it. Hodling Apparel is a great company, and they're giving all of my listeners today 20% off every purchase they make at the Hodling Apparel store. Again, promo code for this one will just be BMS20, so that just stands for Bitcoin Made Simple, and then the number 20. Very easy to remember. Links for all the sponsors will be in the description of today's video. Of course, I'm not going to recommend sponsors or products that I don't use myself. They're all great products, and they're Bitcoin only. So I really hope you enjoy this interview with the one and the only James Lavish. I'll talk to you guys on the other side of it. Let's get into it. Welcome back to the Fix the Money, Fix the World podcast. Today, I'm joined with a man who has created the most informative and probably fastest growing newsletter there is in the Bitcoin and the macro space. Mr. James Lavish, how are you doing today, my friend?
Awesome, Luke. Thank you for having me. I appreciate the kind words.
It's absolutely my pleasure. Where are you these days? I think last time I saw you, you were in LA. I know Pacific Bitcoin Conference is coming up. Are you traveling at the moment? Or?
No, I'm at home. I'm in Las Vegas, but I will be at the Pacific Bitcoin Conference. I'm speaking there. I'm pretty excited. It's going to be a good show. So good place to see a lot of people that that have high signal. So I'm pretty excited.
Speaking of high signal, I want to jump straight into one of your newsletters, James. And this podcast should be out before the Pacific Bitcoin Conference goes live. So anyone listening in, get on over to LA and watch James speak. It should be a cracker of a conference, that one. So maybe I really want to zoom out and maybe give people the big picture, James, before we kind of get into the nitty gritty details of Bitcoin macro and all of that. So I want to actually share my screen. I want to show a couple of charts that you released in a recent newsletter. And this newsletter was titled, it was a Halloween special, and it was titled The Zombie Sovereign Apocalypse. So anyone listening in on the podcasting platforms, this is your signal to get on over to YouTube and check out the video of this interview, because I want to pull up one chart right here. And that is is it the G7 nations, James?
Yeah, this is the G7, and this is the end of 2021. So these numbers, though they're directionally, they're all heading in the same direction as you can imagine. They're a little bit stale, but for purposes of our information, it's good enough, and it demonstrates what we're looking for.
First, before we get into the numbers, you can just tell the listeners what a zombie corporation is, and then maybe let the listeners know what gave you the inspiration to start calling countries zombie sovereigns, because that's the first time I've heard nation states actually be called sovereigns. I think it's a great analogy. So maybe just break that one down for the people.
Yeah, no, a zombie company is a company that is it's operating in a deficit, right? So basically, if you look at your revenues and your your income and your expenses, and many companies have debt, right? So, and they service that debt through their earnings. And if you're a normal operating company and you're healthy, then you have a multiple of earnings to cover that debt. So say you've got $100 million of debt, and your income, or your net income is $1 billion. Well, then you're servicing that debt without a problem, right? So before interest and taxes. So, but zombie companies don't cover their debt. So what happens is they have to issue more debt. So let's say they have $100 million of interest payments, but they're only taking in $80 billion of income before interest and taxes. So they can't really service that debt. So what do they need to do? They need to borrow more, and that's a zombie company. So and if you look at the United States and you look at these G7 companies or these G7 countries that we had up on the screen there, none of them cover their debt. And that's the problem, is they're all operating in a deficit. So if you look at that right-hand column all the way to the right-hand side, you could see that every country is operating in a deficit, which means that the only way that they can fix that is either to cut spending or raise taxes or borrow more. So if you think through that, you've got cut spending. Well, people who are benefiting from those programs don't like it. So that's not a typically a popular thing politically. So that's difficult to get through, to cut spending. Austerity, as we've seen, is difficult to get through. I mean, just look at Italy, right? So, and then the second thing they could do is raise taxes. Again, that's not very politically popular across the board, number one. Number two, the problem with that is that long term it stifles productivity. So your GDP would actually go down, and your income would actually go down, as your tax revenues would go down over time if you raise taxes. So that doesn't really work. And so the easiest thing to do is just issue more debt. And so you and I have talked about this, and we've got all these countries who are issuing all this debt, and they're operating like zombies, and they're in what we call a debt spiral, or it's a debt trap, and they can't get out of it. And the problem is that your interest and your borrowing is growing at a faster rate than your income is, than your tax base is. So once you get over 100% debt to GDP, it's very difficult to get that back down. And that's kind of the spot we're at. And that's why we've been talking about the debt spiral so much recently, is that people are waking up to the fact that all these countries are operating in a deficit, and they're just borrowing more and more and more and printing more and more money to make it all work. And it's a house of cards built on debt. And sooner or later, some of those cards start to fall. So, and that's the problem.
And we're certainly watching a few of those cards start to fall today. And that's actually, before we get into the dollar milkshake, I want to add a little bit more color to that. I think, was it Hirschman Capital who did a report in 2020, and they said, hey, look, since the year 1800, 52 countries have reached debt to GDP of 130%. And out of those 52 countries, was it 51 of them have defaulted within 15 years?
Yeah, it's something like that. It's like virtually all of them default. Once you get over 130, it's just, you can't come back. And the United States is, if you pull up, that's actually because it's the end of 2021. If you flow through numbers through 2022 on a pro forma, you're looking at really a debt to GDP of 137% now. And so, you can make the argument that the U.S. won't make it. However, it's the United States, where the U.S. Treasury is the de facto global reserve asset. So the U.S. is in a different position. And when you look at all these countries, they all have debt denominated in their own currency, so they can keep up this charade for a long time. And just look at Japan, 250% plus debt to GDP. Japan now owns over 50%. The Bank of Japan, the Japanese central bank, now owns over 50% of government bonds. Just think about that. It's just ludicrous, right? So, but people have confidence that they can keep this going, and they continue to invest in that currency. Now, what we've seen over the last year is that Japan, and Luke, you and I have talked about this considerably. Japan has been manipulating their yield curve so drastically that they're causing problems for their own currency, right? So if you pull up there you go, the 10-year yields, right, of all these countries, and it starts out simply as interest rate parity, right? So the United States leading the world in raising interest rates as we're trying to battle inflation. Europe is a little bit behind. Great Britain is a little bit behind. Japan is way behind. And so what you see is that as we raise rates on our 10-year, and Japan is doing the exact opposite. They have said, the Bank of Japan has declared that they are going to stand at the Treasury auction and in the market for treasuries of the 10-year Bank of Japan JGBs, and keep that interest rate at 0.25%. They're going to manipulate it to the point where it stays at 0.25% by buying anything anybody sells to make sure it stays there, right? So the problem is, as they're doing that and investors are selling those treasuries to them, well, they're receiving yen, and they don't want to hold the yen because they know that what the Bank of Japan is trying to do is drive up inflation. And they don't want to lose money on that trade. So they turn around and sell the yen. And of course, we're seeing that it's been tremendous pressure on the yen over the last number of months. And the yen is down somewhere between 30 and 40% over the course of this year. And, there has to be the pressure builds up in the market. And they're manipulating it and they're moving it, but the pressure has to be let out somewhere. And the release valve has been the yen, and that's what we're seeing. And so the last 10-year auction that just occurred over the last couple of days for the Bank of Japan bought every single one of those bonds. There was no buyers. And before that, last week, or the week before, there were 3 or 4 days that the market didn't even open. There were no trades. So now that 10-year trades by appointment because they've manipulated it so drastically that there's, the buyers are not even in the market. So if you look at their yield curve, it's got a hump in it right around that 10-year because they're manipulating. They're keeping the short-term treasuries under zero. So they're negative real rate and then negative nominal rate, and then they're keeping the 10-year at 0.25%. It's absolutely insane what they're doing out there. And so I do think that the yen it's in trouble. If they keep doing this and the Fed keeps raising rates, it's going to continue to be painful for them. So that was a long answer. No. I typically have long answers. I apologize. So.
Hey, I'm the exact same when I'm on podcasts, mate. I can't shut up when I start talking about this stuff. It's fascinating, and that's why you're here. No, don't be silly. Don't be silly. It's what we got you on for, mate. Break down the macro. And I think Japan, I think that's a great point you make about them. I haven't seen many other people follow Japan as closely as you have been. So I definitely wanted to get you on and break down the Japan situation because obviously Japan's a little bit of a unique one. They have that debt to GDP of 250 or 60 odd %. And they're actually the one country out of those 52 countries that we mentioned earlier that haven't defaulted on their debt yet. But when we start looking at maybe this is a good point to jump into the dollar milkshake thesis because you wrote a really good article on that in your newsletter. This is it up on screen for any of the listeners. Highly recommend you get around it and go and read James's. How many newsletters have you written, mate? There's a few in there.
It comes out every Sunday morning. And, Luke, I started writing it because I realized that there's so much that we talk about. There's so many things in our world of finance, especially in institutional finance, that we just throw around these acronyms and these terms and these concepts. And we think, well, it's second nature to a lot of people in my world. However, it's not taught in our schools. It's not taught even, a lot of the stuff isn't taught in business school. And so I realized that, there's some things that we can educate people on, especially. And so as I started to talk to people on Twitter about Bitcoin, about finance, about macro concepts, I realized that, we throw around these things and it's it's super opaque. And I'm sick of Wall Street and institutional investors acting like they're holier than thou just because they know these terms and concepts. It's just a language. It's not that difficult, right? So if you understand the underlying concepts, then you'll understand all of it. And so I started writing this informationist newsletter just to give people an understanding of what's going on in simple terms. So you could be somebody who's highly intelligent but not educated in finance, like surgeons. I have a surgeon who my wife met out in the wild. He's like, wait, your husband is James Lavish. I read his newsletter. And so, which was wild. But the thing is that, he's a really smart guy and he just he hadn't been educated in finance. Or you could, I've got, my sister-in-law is a nurse and she's starting to understand these concepts, and she's not a nurse. That's not fair. She's in the medical industry. She does respiratory, respiratory stuff. So, but she has no idea about the financial stuff, but this is helping her understand it, And so, again, I've written it for, I think 38 weeks. And it's just something I sit down every Saturday morning. I start to talk about something that's kind of at the front of people's minds that we've been talking about a lot on Twitter, or you're seeing in the news or whatever, and just give people an understanding about it. So that's it.
I love it, man. That's what it's all about, like breaking down these really complicated terms. I think that's what your newsletter does really well, like things like the dollar milkshake. People, like a lot of new people hear that a lot, especially recently, but they don't actually know what it is. But I think there's one chart that I've come across that kind of breaks down what the dollar milkshake theory is, or what it's doing to countries and currencies around the world, better than most other charts. And that's this one here. So
Yeah,
it's, I love this chart. So maybe you can break down briefly what the dollar milkshake theory is, kind
sure.
of pulling apart a couple of the themes from that really good newsletter you wrote, and then kind of walk the listeners through what we're looking at on screen here.
The DXY is it's like an exchange rate that includes a bunch of different currencies. So you can see where the US dollar, how the US dollar is doing versus other currencies. And it was back in 1973 after Bretton Woods, we went to a floating exchange rate. And so they included the euro, the yen, the pound, you can see there, the Canadian dollar, the Swedish krona, and the Swiss franc. And for people who don't know that, the SEK is a Swedish krona and the CHF is a Swiss franc. And so, and that was just a way to kind of measure how the dollar was doing versus all these other currencies, because so many countries had pegged their currencies to the dollar. And so, but as the US dollar strengthens and other currencies weaken, it puts pressure on the countries who have US dollar denominated liabilities. So it forces countries in like emerging markets to either print more of their own currency or to buy more US dollars, which is kind of what we're seeing now. Is you're seeing all of these as the dollar goes up, it causes more problems. So especially if you have US dollar denominated debt, so, or liabilities, euro dollars, for instance. And so Brent Johnson of Santiago Capital came up with this concept. He calls it the dollar milkshake theory. And it comes from the old, oil rigging days where you'd buy a piece of land that is next door to another piece of land that was oil rich. And so you would drill down and drill across and have a really long straw and slurp some of the oil out of that neighbor's land. And so that's where that's kind of the straw, the dollar, the milkshake theory, right? So if you talk about the milkshake for the dollar, it would be the milkshake is the foreign currency. So you're sitting across the cafe, right, Luke, and you've got a milkshake, and I'm on the other side, and I've got a really long straw, and I can dip my straw into your milkshake and drink it from all the way over there. Well, the milkshake is your foreign currency. The straw is the US dollar denominated liabilities, the US dollar denominated debt or euro dollars. And then the US dollar is the one who's drinking, right? Is just taking all of those currencies or pouring it into their own milkshake, right? So, and that's kind of the theory. And we're seeing it happen. We're seeing it happen right now as the dollar gets stronger. It kind of feeds on itself. So, especially as the U.S. raises interest rates, and you have the interest rate parity situation, and that's just simply where if an interest rate is exactly what we're talking about with the yen. So I had a post recently about this, where if you just take the 10-year U.S. Treasury and you subtract out the 10-year Japanese Treasury, and you get that difference, right? And you chart it. If you look at that against the yen, it follows it exactly to that movement over the last year and a half, over the last year. And the reason for that is that interest rate parity, right? So if I can get a better interest rate in US denominated treasuries, I'm going to sell the Japanese denominated treasuries, sell the yen, buy US dollars, and buy US treasuries. So that's how that parity works, right? And if you take it one step further, you'll hedge out your dollar yen exposure later with forwards. But that's an additional concept. But basically, the point to know is, as the U.S. Treasury raises our interest rates and Japan does not, then it causes all that pressure, because their central bank is diverging from the Fed, and so dollar milkshake.
So I wanted to quickly interrupt today's podcast and let you guys know about some massive Black Friday sales that our sponsors are having this week, okay? So from the 22nd to the 28th of November, you guys can get 21% off this massive bundle deal being put on by Shift Crypto. You guys will know they make the Bitcoin only hardware wallet called the Bitbox 02. And for this week only, you guys can get a Bitbox 02, a steel wallet, 5 tamper-proof evident bags that are great for traveling so that you know nobody's peeking into your goodies while you're traveling, and you can get 3 backup cards, all for 193 big ones. That is 21% off the normal price. And for this week only, from the 22nd to the 28th, you also get 10% off absolutely everything over at Shift Crypto. So I highly recommend you go and check that out. Get yourself a Bitcoin only Bitbox 02 hardware wallet. And of course, let's not forget about Amber. You guys know Amber has just rolled out to a lazy 62 countries this week, okay? So you guys can see from the Twitter page, we've rolled out in Canada, we've rolled out in India, we've rolled out in Germany, we've even rolled out here in El Salvador. So pretty much everywhere around the world, you can be stacking Bitcoin from a safe Bitcoin only exchange. Now, to celebrate, Amber is giving you guys $10 of free Bitcoin just for signing up with the exchange. You don't even need to buy any Bitcoin. Just sign up and get $10 of free Bitcoin if you use the link in today's video description. Highly recommend you check Amber out. They're a great company, great Bitcoin only company. Without further ado, let's get back into the rest of this interview with the one and the only James Lavish. Exactly. That's a great breakdown. And what's really interesting about this kind of US dollar bull market is it's not just like these little emerging market countries or Latin America or Asia having trouble with their currencies. It's literally the largest currencies all around the world. So I think you briefly touched on the BOE earlier, the Bank of Japan, the Euro. All of the largest currencies in the world have lost 15 to 25% of their value against the dollar. So it's pretty outrageous to watch it all unfolding like it is.
Right. And so people are talking about, well, let's have another Plaza Accord, right? Mm-hmm. So back in 1985, there was an agreement between the UK, West Germany, France, Japan, and the US, where they would try to depreciate the US dollars. They would actually go into the market and depreciate the US dollar. And the US dollar had gotten so strong that it had gotten so strong that it was actually hurting US exporters like the auto manufacturers and Caterpillar, and so they argued to the politicians that, hey, look, it's hurting GDP, it's going to hurt your tax revenues, we need to do something about this, and the United States capitulated and they came up with the Plaza Accord, and it's called that because they had a meeting between all these central bankers at the Plaza Hotel who decided that they were going to do this and they were going to depreciate the dollar. So people are like, well, let's do the same thing today. Well, first of all, the US dollar is nowhere near as strong on a lopsided basis as it was back in the 80s, right? So that's number one. Number two, we have a major inflation problem right now that the US dollar being stronger actually helps battle that. And that's because the U.S. is a net importer, right? So the cost of goods being imported decreases as the U.S. dollar gets stronger, right? So it actually helps inflation. So the Fed isn't going to rush out and manipulate the U.S. dollar right now, knowing that it helps inflation. That's the second thing. And then the last thing is, like, if you look at the last Plaza Accord and those partners, well, a number of them folded into the EU. Right. So now our major trade partners are the EU, the UK, Japan, and China. Right. So, and China has absolutely no, they have no motivation to do something that would make the yuan stronger. I mean, that wouldn't help their current. They have their own problems that they're dealing with, and a stronger yuan is not going to help that. So, really, until the US dollar becomes so strong, Luke, that it starts to impact the U.S. Treasury market and make it disorderly, then as far as the Fed and the Treasury are concerned, well, everybody else is just going to have to deal with the stronger U.S. dollar. So we are seeing signs that the U.S. Treasury market is becoming less liquid, and that is problematic. And we've heard Janet Yellen come out recently and say, look, we'll do what we have to do to make sure that it stays liquid. And she talked about doing a few things, and we can get into that if you like. But the bottom line is, look, the Treasury market's got to stay liquid. It's got to stay orderly. And until that happens, the Fed is going to stay on the path that they're on, which is raising rates. So that's kind of my feeling on it.
Couldn't agree more with you. And I think in early 2020, that's actually what made the Fed come out with QE infinity. They didn't care about stocks crashing initially. I think there was a 4-week crash. Over 4 weeks, the S&P lost something like 20 or 25%, maybe 30% in 4 weeks. And the first 3 weeks, the Treasury market was liquid, well, kind of, and it was pretty functional. But that last week of that crash, the Treasury market started playing up a little bit less liquidity, and obviously the Fed steps in with QE infinity. So that's certainly a really good sign that you're keeping an eye on. Again, you have written another great newsletter on the Treasury market liquidity, so I'll definitely recommend the listeners definitely go and check that one out. But just quickly, what are some of the signs there in the Treasury market that kind of have you concerned?
Yeah. So, I mean, well, there's a few things. Number one, when you kind of look at, first of all, you look at the auctions and you see how the auctions are doing. And the auctions they haven't been terrible, but they haven't been great. And so, the 10-year is kind of your benchmark. And watching the 10-year, well, we've had a number of tailing auctions in a row. And what that means is that the market trades when issued, right? So the Treasury announces that they're going to have this auction for the bonds, and they're regular. There's hundreds of them throughout the year, right? So, but when that auction is going to be, and then they allow it to trade when issued prior to the actual auction, right? So the way an auction works is that those trade when issued, and then they have something that's called a Dutch auction, right? So I go into this in one of my newsletters, and it breaks it down very simply for people if they want to see it. But I think it's called when Treasury auctions fail or break down. So, but the point is that the Dutch auction means that the buyers of these treasuries, okay, these commercial banks go in there and they bid for the treasuries, but they bid at a certain rate for a certain amount. And then they're kind of locked into where those bids are as that auction happens. And then the Treasury goes in and says, okay, well, we're going to sell the treasuries up to this percentage, this interest rate, in order to fulfill what we're trying to sell, the amount we're trying to sell. And so that's the Dutch auction. You may or may not get filled. And if you get filled, you'll get filled at or below your bid. So whatever interest rate you bid at. Okay. So knowing that, that the auction ends at a certain interest rate, but the when issued market had been trading at a different interest rate typically. And if that when issued interest rate is lower than the auction interest rate, it means the auction wasn't that great, that when issued market thought it was going to go better than it did. And so the reality is that the demand wasn't there at the interest rate that people thought it was going to be. And so the difference there is the tail. And so if that tail is big, now we're talking about basis points here, 1, 2, 3 basis points. If you get like 4, 5, 6, 7 basis points, that's almost catastrophic for the amount of money and the size of the treasury market we're talking about. So we haven't seen that yet in the 10-year, but we have seen a number of tailing auctions, which means that it's not as good as people thought it was going to be. Now you also have the BTC, which is big to cover. There's been enough demand, but again, there's going to be a time where there's not enough demand. And that's what the Treasury and Yellen, that's what they're watching. The second thing is you're watching the actual open market, the trading of these treasuries and how liquid it is. Well, so there are a number of indices that show this, right? So one indice is the Bloomberg liquidity index. And so you can see on there, and it really maps very closely to what's called the MOVE index. And I think it's a Bank of America index, and it shows the option trading in the market, and it implies a volatility. And so why does that matter? Well, if something's very volatile, it means that there's not a lot of liquidity, right? There's not a lot of buyers and sellers at all these price points really close to the last sale. So if it's moving up and down quite a bit, it's got to move enough to get filled, those orders to get filled. So there's not a lot of liquidity. That's bad. You want a lot of liquidity. Why? Well, because when you have a market shock and somebody comes out with a huge order that has to sell and they can't get filled, and it forces that price way down and that interest rate way up, that's volatility, and that's bad. And so you're watching that index, and the higher that index number is, the worse it is. And that index number is getting right. I think it's above the 2020 March levels already. And so that's concerning. And so again, that's why you've got Janet Yellen coming out and saying, okay, we have an idea. What we're going to do is we're going to trade with the holders, these commercial banks that hold these bonds. We're going to buy some of those bonds that don't trade so much from them. Okay, so these are long dated 30-year treasuries, and they're called off the run. Why are they called off the run? Because back in the day, back when I started, we'd actually walk into the bond room and the bond trading room, and they'd have these sheets, and they were on those dot matrix printers where they had the holes on each side of the sheets. You tear it off, right? But they had reams and reams and reams of these, bond issues that they were looking at every day, right? So you didn't have computers like we do now. So you'd actually look up the bond in your sheet to see what the price is, what it should be, where it traded yesterday and whatever. But that's called on the run. And if it wasn't on that sheet, it's off the run. It didn't trade enough. And so you're like, I don't want to trade this. That's what they're looking at, is they're saying, well, there's some bond issues that are just not liquid enough that we'll buy from the commercial banks and we'll sell them instead. We'll sell them some shorter dated treasuries, some T-bills or notes that are under 10 years that will be pretty liquid. And that will actually help those banks own shorter term paper, because you can only hold so many treasuries on your balance sheet. So again, a long answer, but that's kind of what we're looking at.
A long but a good answer. I thought that was a great breakdown. I think a good way to look at it for new people entering the space is for the first time in 50 years, nobody's buying US treasuries. So Japan, China, Russia's completely de-dollarized. All the largest buyers of treasuries in the world, they're all not only not buying US treasuries, but they're aggressively dumping them and trying to create their own reserve currency. James, I wanted to ask you about the geopolitics. What do you think about the BRICS nations trying to create a new reserve currency and opt out of the petrodollar system and using the US dollar as the reserve currency?
Yeah, I mean, if the BRICS system with Brazil and Russia and India, China, and South Africa, they're looking at the U.S. Treasury, and they know. I mean, the geopolitics there is, and I don't know who's leading it, whether it's Xi or whether it's Putin, but I'm not going to claim I know. So, but speculatively on the outside, it makes sense for them to be absolutely sick of, and Putin actually did state this. He doesn't want to sell oil, receive U.S. treasuries, and have those devalue in the market over time because of inflation, right? So if you think about it this way, as a dollar inflates, you're getting paid back on those U.S. treasuries with dollars that are worth less than when you bought them, right? When they were issued, when you bought them. So they're sick of it. They know that we are in a debt-laden economy, and that all of us, the United States, Europe, Japan, the UK, we're all just printing to oblivion to keep propping this up. And they know that. And they know that we're going to continue to let inflation run over 2% in order to inflate away some of this debt. So that's why they're doing it. It's really, it has to do with being able to separate themselves from being beholden to the US dollar. And it's just a good financial move. I mean, if I've got oil in the ground, I'll keep it there rather than selling it for US treasuries and having that be worth less tomorrow than it is today. So
I couldn't agree more. You know what else is a good move? I actually heard this on a podcast the other day. So obviously Putin exports a lot of his oil and natural gas to Europe. Now that these Nord Stream pipelines have been blown up, Russia's exporting less and less oil and gas to Europe, on top of the sanctions in early 2022 that already restricted the amount of oil and gas Putin was exporting. Well, have you seen the chart of the hash rate going parabolic recently, James?
it's crazy. It's absolutely crazy. Yeah. And I maybe you have a better explanation for it. I think that we've seen a lot of machines, ASICs, come onto the market for very cheap, and they're being plugged in, and people are anticipating a move by the Fed, and they want to be mining ahead of that because they want to have the optionality of Bitcoin as the ultimate risk-on asset right now. But that's just an investment side. What are you seeing, and what do you think?
I see a little bit of that as well. I've heard those rumors. Lots of new mining rigs are getting plugged in. I also heard somebody else who's a little bit more into the whole technical side of the space say that they found some more efficiencies in the Bitcoin miners. I haven't had the chance to dig into that. I'm a little bit of a technical dumbass when it comes to the whole mining side of things. I keep in my lane and just talk macro. But a theory that something that crossed my mind was it wouldn't be outrageous that obviously Putin has so much cheap oil and cheap natural gas in Russia. He's now exporting less to Europe because of the number of the reasons we mentioned earlier. Wouldn't surprise me if he's using all of that cheap, free, abundant energy to plug into ASIC miners.
And we wouldn't know. We wouldn't know. They could be out in Siberia and we would have no idea. Yeah. So it's I don't know. It could absolutely be a huge geopolitical move. And this goes into an article that you wrote recently that, these BRICS countries are sick of being beholden to the dollar. And if they can transfer into a base currency that's hard money, gold and or Bitcoin, they're going to do it, and so they've got oil, but not all of them do. So, but if that currency can be based in something that's hard, yeah, it would make sense, at least for the long term. Yeah.
Oh yeah. And when we start talking about the long term and the demand for Bitcoin, I wanted to kind of close it on a little bit of maybe a more positive note. We've talked a lot about the demise of the fiat system and how it is inevitably going to crash. And I wanted to quickly have a look at a little short thread that you put out. It was a little while ago, but you were talking about where and how Bitcoin gets to $1 million per coin, pure math. Maybe you can break this little short thread down for the listeners and outline how you see Bitcoin becoming a larger part of asset managers' portfolios moving forwards into the future.
One of the things that we haven't really seen is the widespread institutional adoption of Bitcoin as a separate asset class. And I do believe that is going to happen eventually. And so, the numbers in that thread are a little bit different now than they were then, because all of these investment assets are down huge since then. But if you look at stocks and you figure there are about $100 trillion worth of stocks in the world, just look at all the global investment assets. Okay. If you look at stocks, bonds, you got, $100 trillion of stocks, $110 trillion of bonds. You've got 250 to $300 trillion of real estate. You've got 20 to $30 trillion of art and collectibles. You've got about $10 trillion of gold. And you just say that adds up to somewhere about, even if it's just $500 trillion, and then your M2 is over $100 trillion, that's $600 trillion. That's a total of 600 trillion dollars of global investment assets and cash. And so if you just look at the major players, the institutional investors, then you use a conservative 1% to 3% asset allocation, say in the next 10 years, because they realize that this is a separate asset class. This is actually a store of value. Eventually, it is a place that they're going to reallocate some of their portfolio out of stocks, out of bonds, out of real estate, out of gold, into this separate asset class. Well, just 1% of $6 trillion is about $300,000 Bitcoin, and then 2% is 600, and 3% is just about $1 million. So, but the really important thing here, Luke, is how and eventually why that happens, and it's because of the breakdown of that 60-40 portfolio, right? And eventually, these investors are going to realize they need something that's going to be a hedge against long-term M2 expansion. So when that money supply expands so rapidly, and we have all these programs that we're putting money into people's pockets to go spend on assets, well, you're going to need something to hedge against that inflation, right? Not everybody can go out and buy an extra house. Not everybody can, and not everybody wants to be fully invested in stocks. You're not going to want to be invested in bonds because you're not going to get a real rate return on that. You're going to lose money on that, on real rates. The inflation is going to be at or above the interest rate you're going to get on those bonds, and investors are going to realize that. Gold is not. It can be manipulated with paper, and it has been for decades. So it's difficult to hold gold as a physical asset. You can buy coins or whatever, but obviously the easiest, most liquid, hardest, the least, the one that you need the least trust with, you don't have counterparty risk in, is Bitcoin. It settles in just a few minutes, and you can move just about as much as you want pretty cheaply. So they're going to realize that. But the big point here is that, look, you've got five investment firms that control $30 trillion of assets. You've got BlackRock, Vanguard, UBS, Fidelity, and State Street, that they control over $30 trillion of assets. BlackRock's already involved. Fidelity's already involved. And so when those firms, when they come out with products and in their own portfolios that they're investing a portion of their capital in Bitcoin alone, every other firm is going to have to follow. You're just going to have to do it. So that's how powerful that institutional world is. And I do think it does happen. And that's how we get there.
I couldn't agree more. I think the same way you see competitive devaluation amongst fiat currencies to kind of manage their exports geopolitically, you're going to see a very similar kind of competitive allocation to Bitcoin. As when one asset manager allocates to Bitcoin and Bitcoin goes up 200 or 300%, these other guys are going to have to jump on board, and it's just going to be a big domino effect.
That's right.
James, I want to be respectful of your time, my friend. I know that you have another call coming up.
I do. I'm sorry about that. We could talk about this for hours. We could, easily. But I do have another call I've got to get on. But I appreciate it, Luke.
No worries at all. We could quite easily talk about this for hours. James, thank you so much for coming on, my friend. Are there any final comments or places that the listeners can send any emails to you, and where do they sign up to your newsletter? And tell us a little bit about Looking Glass Education if you've got 30 seconds free. Yeah.
Absolutely. Yeah. So Looking Glass it's an educational platform online, super simple, super easy to sign up for. It does be Seb Bunny, Dahlia Plott, Jason Sansoni, Max, and Greg Foss is the guy who actually pulled me into that. We founded this platform, and those guys are the ones who are doing all the work, that they're really in there every single day, and they built this educational platform out. But it's a simple course that you can go through to learn about money. And eventually, you understand why Bitcoin is the answer to so many problems that the manipulated money has caused. And so you can just sign up for the course. You can do it on your own time. You can do it. You can binge it and do it all in a weekend, or you can do a little bit each night, however works for you. But it's a great way to understand the financial world and money, and why Bitcoin is the hardest asset out there, why it's the hardest money out there. So that's a really, really awesome project that I'm thankful to be a part of. But I can't claim that I'm one of the leading builders of it. These guys are the ones who are doing all the work. So that's the first thing. You can find me on Twitter. I'm always on there. Just James Lavish. It's just at James Lavish for Twitter. And my newsletter is in my profile, my Substack, or there's a little banner you can sign up for through Twitter. It's free. The information is free, and it comes out each week. And if you want to talk to me, you can always respond to something on in one of my tweets, or you can just respond to one of the newsletters. I try to answer all of them. I'm a few months behind now. It's a little bit overwhelming, but I do try to answer all of the emails I get on the information. So.
It is a little bit difficult sometimes catching up on emails and comments, especially on Twitter. Thank you so much for everything you're doing. Bitcoin education is something everyone needs to focus on, and you guys are doing great work. I recently actually had Foss on the podcast just last week, and we talked about Looking Glass education a little bit there. So, awesome. Jane, thanks for all you guys are doing. It's amazing. And thank you so much for your time today. I'll let you run.
Absolutely. Thank you for having me on, Luke. Always like talking to you, and we'll do it again soon. Thank you.
The feeling's mutual. See you, mate. Have a great day. So what did you guys think of that interview with the one and the only James Lavish? I really hope you enjoyed it and you got some value from it. If you did, feel free to like the video here on YouTube and subscribe to the channel. And if you do have a spare second or two, give us a nice review on Spotify, or give us a bad review. It doesn't worry me. Let me know in the comments down below what you thought of it. And obviously, come hit us up on Twitter. James and myself spend pretty much 24 hours a day on Twitter. It is a little bit of an addiction. But without further ado, I hope you guys really enjoyed that one. But I think it can be safe to say a good summary from that episode is the fiat Ponzi is absolutely, inevitably going to break. And there is only one solution, and that is Bitcoin. I would like to thank James again for his time for popping on. I hope that you guys got some value from it, and I will see you guys in the next podcast. If you have anyone that you would like me to interview, you have any suggestions, let me know. Drop them in the comments down below. Send me a DM on Twitter. I'll reply to everyone. I really do try to catch up on all of my DMs, so reach out, and I would love to hear from you guys. And until I see you again, I'll talk to you guys in the next podcast.